Ted, welcome. Ted, what's driving the rise in direct lending of the middle market, and how is that impacting the broader credit landscape?
It's interesting. Direct lending is a function of the private equity markets primarily. So as the private equity markets have grown over the last 20 years, direct lending's been the primary beneficiary, because for every dollar of private equity money invested in a company, there's a dollar of direct lending money invested. And when there's $1 trillion of dry powder sitting today in private equity dollars, that means there's a hell of a demand for direct lending. Years ago, the banks did most of the direct lending in the country. After the financial crisis, because of the regulations, the banks did less because of capital requirements. So what happened, it pushed out all the direct lending into the institutional market, and asset managers, insurance companies, pension funds, endowments, foundations, high net worth individuals, they now own most of the direct lending dollars. And I see the trend continuing. Our business has grown at a 25% CAGR for the last 15 years.
There's a lot going on in the world at the moment, not to mention macro pressures, competition. What do you think that lenders need to specifically focus on when it comes to the risks in this environment?
For us in the lending business, risks involve losing principal. That's the ultimate determiner of whether you're successful or not successful. So from a direct lending standpoint, we're very, very focused on covenants. We're focused on early warning signs. We're focused on documentation. We're focused on remedies. We're focused on workout ability. Those are the things that are driving recoveries. Now, in the upper market, recovery rates are starting to go backwards. That's not a good sign. So we're very, very focused on that. In the lower part of the market, we still have good recoveries because we're able to sell businesses and hire investment banking firms, sell divisions. Upper middle market, it's harder. There's not a lot of liquidity today. M&A is down, and that's driving, I think, some of the negative recovery rates.
What do you think is going to set apart the long-term winners as private credit gets more crowded?
There's more and more competition coming into the space. Asset managers, insurance companies, European investors, lots and lots of competition, only because the market's grown so much. So nothing really changes. It's about sourcing, it's about underwriting, and it's about collecting money. And it's about building the right infrastructure, having the right people. And this is not a high growth, business. The goal is to stay disciplined, stay consistent, and be very stable in your process. We generate consistent returns, and that's what is going to determine who the winners are over the years.
Ted, thank you so much for your time.
Thank you.